Roth or traditional, this single choice made once when you open an IRA can quietly cost or save you tens of thousands of dollars in retirement. And the honest answer is not the same for everyone. It depends on a bet you are making about your own future. Let's break down exactly how that bet works. Here is the entire decision in one question. Every dollar you put toward retirement gets taxed at some point. The only choice is when, with a traditional IRA, you get a tax break right now, when you contribute, and you pay income tax later, when you withdraw the money in retirement. With a Roth IRA, it works the opposite way. You pay the tax now, up front, and then every dollar of growth comes out completely tax-free in retirement. So the real question is this: will your tax rate be higher now or higher in retirement? The scale of this decision is bigger than most people realize. Say you contribute $7,000 a year for 30 years, averaging an 8% annual return. That grows to roughly $880,000. In a Roth account, that entire amount belongs to you, tax-free. In a traditional account, the government still owns a slice of it. You just have not paid that tax bill yet, and it comes due the moment you start withdrawing. Let's look at scenario 1, early career, low income. If you are just starting out, you are likely sitting in the lowest tax bracket you will ever be in for your entire working life. Paying tax now, at that low rate, locks in a bargain. You are essentially prepaying taxes at a discount. Then decades of compounding growth come out on the other end completely tax-free. For most people early in their career, the Roth usually wins. Now scenario 2, peak earning years, high income. If you are in your highest earning years, the traditional deduction reduces your taxable income while you are sitting in your highest bracket, which means that tax break is worth significantly more to you today than it would be at a lower bracket. And in retirement, your income and likely your tax bracket may actually be lower than it is right now. For high earners at their income peak, traditional often wins. Here is a factor that rarely comes up in these conversations. Required minimum distributions, or RMD's traditional accounts, force you to start withdrawing money at age 73, whether you actually need it or not. And every withdrawal is taxed as ordinary income. Roth IRAs have no required minimum distributions during the original owner's lifetime, which means your money can keep compounding, untouched, for as long as you want it to. There is one more wrinkle worth knowing. Roth IRAs have an income ceiling. High earners can be phased out of contributing directly at all, but a backdoor Roth conversion, following the correct IRS steps, can still get money into a Roth account even above that limit. Traditional IRAs, on the other hand, have no income limit on who can contribute, though the tax deduction itself may be limited if you also have a workplace retirement plan. If you genuinely cannot predict your future tax bracket with confidence, and honestly most people cannot, there is a practical answer. Contribute to both types of accounts. This is sometimes called tax diversification, and it hedges your bet both ways. It also gives you flexibility later, letting you control your taxable income in retirement by choosing which account to pull from each year. Let's wrap up. If you are in a low tax bracket now with decades until retirement, lean toward Roth. If you are in a high tax bracket now and expect it to drop later, lean toward traditional. Roth accounts skip required minimum distributions entirely, giving your money more years to grow tax-free. And if you are not sure which way your future goes, contribute to both and diversify your tax exposure. This Friday, we are covering one of the most debated and misunderstood strategies in investing. Short selling, how traders actually bet against the market, and exactly what can go wrong when that bet fails. See you then.